This is an important topic. Let's get right to it. On our first panel this morning, we have truly some of the leaders of this industry. As I mention your name, do join me up on stage. Please welcome Frederick Cannon, Managing Director of Research at Keefe, Bruyette & Woods, Angelo Mozillo, Chairman and CEO of Countrywide Financial, Robert Toll, Chairman and CEO of Toll Brothers, and Dr. Mark Zandi, co-founder and chief economist, Moody'sEconomy.com. Good to see you, Angelo. Thanks for being here. Hi there. How are you? Good to see you. Hi there. Good to see you. Well, we heard the statistics just a few moments ago of what's going on in the business. Why don't I kick it off, and I hope we can be as conversational as possible. So if you hear something that some of your colleagues on the panel, if you agree with, you disagree with, please jump right in so we can have a conversation. We do have microphones in the audience, so please do get some questions ready because I'm hoping to come to all of you to also participate in the conversation. Let me kick it off as the status of where we are right now. Angelo, give us a status check. Where are we in this cycle of slowdown for housing?
Well, I don't know. I don't know why you'd pick on me first, Maria.
Well, you're the leader.
Yeah. I think the Secretary laid out a good portion of the issues, but I don't know where we are in the cycle. I wish I did. But I think we're dealing primarily with the results, and not. I think Hope Now is a very important initiative. I think all the initiatives are very important to avoid foreclosures, but I think we're dealing clearly with the results and not with the cause. Nobody's addressing the cause, and that's what has to be addressed ultimately, and that's the fact that values of homes continue to go down, and as they go down, the problem gets exacerbated. And until we stop that cycle, we'll continuously dealing with this break in the dam, and that the cause of the deterioration in values is a lack of liquidity. You'll hear that throughout this whole, I'm sure, the capital and liquidity, but liquidity primarily. I mean, we're at the forefront. We deal with the mortgagor. It's very difficult to get financing today to buy a home unless you're in with the Freddie, Fannie limits, and many areas of the country beyond that. And so the cycle is, the major cycle is house price deterioration. And it's interesting to me, then I'll stop talking. It's interesting to me that we had none of these problems while values are going up. We were making these loans for 5 or 6 or 7 years, no problems, no delinquencies, no foreclosures, same loans. But values are going up, and people are able to work their way out of a problem either through refinance or selling the home. You know, they had equity. Once their equity was gone, then the problems were exposed, and that led to a whole series of actions, including lack of liquidity in the secondary market, cut off liquidity in the secondary market, and the only available liquidity being Fannie and Freddie. And so that's the issue that has to be addressed, and that's a very complex one. The one we're dealing with today in terms of resets and how we deal with resets is relatively easy. That can be done and will be done. It's how do we stop it? And you have to get the inventories that the Secretary talked about are huge inventories of homes that have to be purchased, and it has to be liquidity for people to go out there and purchase. And that's the problem as I see it.
Robert Toll, how do you see it?
I don't see it as a liquidity crisis because the reality is we had a housing crisis long before we had this subprime debacle and so-called liquidity crisis. The housing market went bad with Katrina 05. I don't know what the connection is necessarily, but I could make it up. But so can you. Lack of confidence. We saw ourselves as incapable and like Bangladesh in a storm, people floating upside down, and the government couldn't do anything about it. Excuse me. And too many people went to the window at the same time and said, you know what, cash these. Of course, you had no housing crisis when housing prices are going up. How could you? If you can't afford to pay the mortgage, sell the house, take the profit, go buy another one, and keep on rolling. The problem was that it became too easy. We had mortgages available to the alive and standing, and those were about the only criteria. Again, why not? Because if the guy can't pay the mortgage, he's going to sell the house for more money, and we'll keep on rolling. And so it was good times. We had probably 15 to 20%, that's not a lot, 15 to 20% more demand in the market than under an owner-occupied situation, circumstance. When they went to the window, not only did they stop demanding, they started supplying. So if you've got 15 to 20 stopping in demand and adding to supply, you've got all of a sudden 30 to 40%. Now that's a big number, differential in the market. And what happened was that hit us like a ton of bricks. Housing prices started to fall, and they may not have stopped falling yet. Certainly I'm going to say that this is the best time to buy a home. You've got sellers on the ropes and buyers so reticent, you're going to kick yourselves for not scooping up all those condos in Florida. But that's for another time. I think we can do a lot to help ourselves out of the situation. You know, once upon a time we passed speeding limits, and everybody said this is un-American. You know, tell me that I can't rev it up in the Southwest and do 100 miles an hour, or in Maine do 75 or 80. But we learned to live with it. Double nickel speeding limits for a long time to conserve energy. Maybe we ought to rethink that. And to conserve lives. There's no reason why we can't set limits to how we originate these loans so that we don't get caught with people that can't possibly pay other than by selling out of an investment that goes up, because, as we know, they don't always go up. And so I would urge that the legislation be carefully drawn and that regulation be put in place very carefully so as to set limits, not guidelines, but limits, so that you can't negative am a home, so that you can't teaser 2, 4, 6, 8, who do we appreciate, and so on and so forth. And I think through a decent amount of study in the Senate and in the House, we can get ourselves some regulation so that we learn from this and prevent it from happening again. We're not going to make it go away. It's happened. There's the right of contract out there. There's lenders. And you can't just say, you're going to take the hit. I mean, you know, why pick on the poor sap in Germany who bought a bond that's backed by a bond that's backed by a bond that has to do with a schlub who bought a house for 1% interest rate, and then he goes to 8%, and the house is now dropped by 20% in value. Why can't the German investor get out of that situation? Why does he have to support the poor fellow that bought the house that was teased into it? Now, we can't regulate used car salesmen. We're not going to regulate originators. But what we can originate is how fast the car can go and what the originator can put on the books.
And of course, we want to get to solutions. We do want to hear your thoughts at some point about what you know about the Treasury plan to freeze certain mortgage rates. We'll get to that in a minute. But Frederick Cannon, you've studied this industry for a long time. What is your expectation of the resets happening over the next year and their impact on the broader economy?
Well, the subprime reset issue is certainly a piece of the issue, as was mentioned earlier. But I think it's important to recognize it's just one piece of a broader issue. If we look at, before we talk just about the resets, it's important to recognize a number of people who won't be helped by the resets. For example, at the end of June, already 20% of subprime loans were either delinquent or in foreclosure. Helping with the reset problem won't help those people. We know that a large share of the subprime loans were actually made to investors rather than homeowners. That's not set up to help those people. So we do believe there's a number of individuals, and certainly it's a positive that we can help address the reset issue. But I think it's very important for everyone listening to know this problem is much deeper than the subprime reset issue. We saw just 2 weeks ago, Wells Fargo announced an 8.5% loss on a pool of prime home equity loans. That has nothing to do with the reset issue. So we're seeing losses spread broadly. And as we look out, I think it's important to recognize some of the things that were already said, I think especially by Angelo, and that is that the real issue underlying this is home prices are down. We had years of what I call asset-backed lending rather than income-backed lending. And because of that, we have a situation that's going to play itself out over an extended period of time. And investors globally don't really know what to buy or how much to price these assets because home prices are falling at an accelerating rate, and we really don't know the number of defaults that are going to be out there. So as a result, we have to get through a pretty difficult time to find a bottom. Addressing the reset issue is just one part of an overall everything that needs to be addressed here.
So how do you get through that? How do you operate in an environment where you really don't know what the securities are valued at?
It's tough. I think that one of the challenges we find right now is that that's essentially what makes it tough. What we have to have is we have to have some investors willing to step into the market to value those securities. But really what we need to have is something that was mentioned by both of the gentlemen earlier, and that's really what we have to have people start stepping in and buying houses. Because until we find that bottom in home prices, it's going to be very difficult to truly value these securities.
Mark Zandi, how do you see things, and do you see this market bottoming out that perhaps would lure home buyers in?
Well, you'll be happy to know I bought a home in Florida. I think I caught the falling knife, though.
So did I.
I guarantee you did.
Yeah, all right. Stop that. Well, the housing market peaked 2 years ago, over 2 years ago. I think it has at least another year to decline. I'm a numbers guy, so I'll give you some numbers. Home sales peaked at 8.5 million units in the summer of '05. They're now running 5.75 million units, and I think they'll bottom out about 5 million units early in '08, the spring of '08. Starts, they peaked at 2.25 million units in the spring of '06. They're now running 1.25 million. They'll be below 1 million, I think, by the summer of next year. In terms of prices, they peaked a little over a year ago. On the Case-Shiller, they're down about 7%. I'd be surprised if we're halfway done. Somewhere about 15%. Effective declines after non-price discounts, at least 15%. And they won't bottom out until the end of '08, probably early '09. And that forecast assumes no recession, that we avoid recession, which I think is a significant threat. The economy is probably contracting at the moment. It assumes more interest rate cuts. The Federal Reserve cuts rates. It's now 4.5% funds rate, at least 4% funds rate, or now 4.5%. And it assumes a significant amount of loan modification effort success. That so far it's been very bad. According to Moody's, through July, the modification rate was, I don't believe it, but they say 1%, but that kind of gives you the sense of the effort so far. We'll need to see something somewhere between 20 and 30% modification effort in '08 to get to my forecast. If any of those things don't happen, if we have a weaker economy, recessionary economy, if the Fed doesn't become aggressive, if the modification efforts do not pick up significantly, I think it's at least through the end of the decade, and the declines will be much more severe.
What was the denominator in terms of 1% of what?
That 1% of all the loans that came up for a reset between
Subprime or all loans?
all loans between January and July of '07, 1% had some kind of modification.
That's probably right. Right. If I could make up, I'm going to stick to my position with all due respect to Bob, who I love, that there is a liquidity crisis. And it's in the secondary market, you really can't, there's no secondary market, and that really has been historically very important in mortgage finance, having a very liquid secondary market long before subprime. Ginnie Mae's started that, but we've had a very viable market since the 70s, and we don't have that market anymore, and I think that's essential. Secondly is, liquidity is both on the back end and on the front end for the mortgagor to buy a home. That's one of the reasons why the values continue to go down, because there's two aspects to it. One, it's very difficult for people to get financing in high-cost states, if not impossible, but also the psychology of the falling knife. The psychology of the borrower today is, look, rates still have to go down lower and prices still have to go down lower. Until you change that psychology, you're going to have this trend, and what can change it is a momentum of people getting where Bob wants people to go and buy homes today. And you need lower rates to do that, but you need a more active, with all due respect to AFEO, we need a much more active Fannie and Freddie with higher loan limits and taking the cap off their balance sheet so they can participate. It needs a start. at least a temporary start.
I'll vote for that.
We are good, thanks. Thanks, Bob.
I didn't say we don't have a liquidity crisis. What I said was the crisis doesn't come from the liquidity crisis. The crisis comes from the housing crisis, which began at least a year and a quarter, maybe a year and a half, before you even saw the cracks in the liquidity chain. So we know that one of the things to fix it is to overcome the liquidity crisis we have. But in order to get a fix, to learn from the problems that we have now, we can't just fix the liquidity. We have to go to the origination.
Yeah.
to
I think
the beginning.
the origination is self-curing because most originations are gone. Originators are gone, and those who are left know why they're gone. So that's I think, a self-curing process. That's going to be the problem, is that people are just not going to make these loans anymore because of reputational risks, and that's going to hurt a lot of people. But I do think we just need to jump-start it, because I just wanted to
I can reconcile the debate. That's what economists do. Most fundamentally, it's inventory. There's just too much of it. The homeowner vacancy rate is 2.6%. Between 1985 and 2005, it was 1.6%. That translates into 2 to 2.5 million unsold vacant homes. That's just swamping the market. It's why house prices are falling. That's why mortgage credit quality is eroding, and why the mortgage securities market is completely shut down, is a mess. Now, the liquidity problem is exacerbating the inventory problem. Inventories are going to increase before they actually improve. And the only way you get the market going is twofold. One, you cut construction significantly. You've got too much inventory. How do you fix an inventory problem? You reduce supply and you increase demand. So you cut construction massively. We're going to have to go well below 1 million units for an extended period. And you cut price, because that will improve affordability. It'll bring in those investors, and it'll stimulate demand. And therefore, you need both those things in a very significant way. That's why the housing downturn is going to be very severe over the next 3, 6, 9 months. And it's happening now. The most positive development is that the psychology in the marketplace has shifted, which is very important. It's capitulation. People now realize, the builders realize, the lenders realize, the sellers realize that if they hold on, it's just going to get worse. So they're cutting price, they're cutting construction, and so we're going to see a very severe downdraft in the next 3, 6
So we're
months.
talking about two different issues here, really, liquidity versus, or as well as the decline in housing. Let me just talk a little about liquidity for a minute. What caused the credit markets to freeze, Angelo?
Well, the secondary markets, I think probably go back to when Moody's and S&P downgraded bonds that investors were holding. They thought they're holding AAA bonds, and suddenly they're holding something substantially less than that. And that froze that sector. And the total loss of confidence in these securities that were tranched, as Bob points out. There are lots of tranches to these securities. But they were rated by S&P, and S&P said, look, I was just testing your sense of humor. I'm coming back and going to downgrade them. And, people said, what are you talking about? And so that total loss of confidence by the providers of capital to that market said, that's it. We're not touching that stuff anymore. And that's always overdone. And I think that was at least to me, the thing that comes to mind. Maybe the good doctor has a different view of it.
I'm from Moody's, but I want you to know it's not my fault.
It never is.
I sold my company to Moody's 2 years ago, and it's been a great experience, and they are now using my house price forecast, so you can all be assured going forward, we're in good shape. We're in good shape. We're in very good shape.
What kind of responsibility, though, should be held with the Moody's and S&Ps of the world? The ratings agencies clearly missed the boat on this.
Okay. Well, let me just preface my answer by saying I am not part of the rating agency. I'm in an independent subsidiary, but I observe this pretty closely. And I'll say 3 things. One, they got it wrong, but so did everyone else in this room. Pretty much everyone else in this room. They're not alone. I would say this is the most serious housing downturn since the Great Depression. So this is your 1 in 100-year event. So this is very special kind of period. So we all missed it. 2, I think it's easy to say mortgage quality is going to erode. That's pretty obvious when house prices are falling and you see the underwriting standards. It's very difficult to actually pick a security and say that tranche of that security should be downgraded. That's a process that takes time. You need information. You can't do it overnight. It takes a period to gather the information and to be right. And to reinforce that point, if you're wrong in your assessment of the market, you don't want to be wrong in downgrading the bonds because, as Angelo pointed out, it just exacerbates the problems in the marketplace. So you want to be absolutely sure that what you're doing is appropriate. So that also argues for caution and to be deliberate in any decision that you make. And then third, there should be changes. The ratings process is changing. They've adopted my house price forecast. That's a change. I think that's very important. And also, they're developing new tools to understand the impact of liquidity on credit, because I think, as Angelo is pointing out, that credit quality probably would have eroded regardless, but it wouldn't have eroded to the degree that it is if we didn't have this liquidity problem and the consequent impact on housing demand and the downdraft in prices.
Mark, just following up on that liquidity issue, I mean, one of the things looking back, of course, is all lending became, at least for the companies that I've talked to, asset-based, home price-based rather than income-based largely. Right. Now, one of the things looking forward, and obviously, depending on what your home price forecast had been 4 years ago, it might have been different or might not have been different. But right now, there's a second liquidity issue, and the liquidity issue is that homeowners and home lenders are tightening up quickly. Doesn't that just add to the liquidity challenges that we face as a homeowner tightens up, and what does that mean for the consumer moving forward?
Yeah, no, it's all now self-reinforcing, right? We're now in this self-reinforcing negative dynamic where house prices beget credit problems, which undermine the value of the securities, which beget rating downgrades, which begets a lack of liquidity in the marketplace, which causes lenders to tighten up, which causes demand to weaken, which causes and you're off and running. And now adding to this cycle is that we're throwing the economy into the mess. It's now bleeding out. It's affecting consumer spending, and it will measurably more so as we make our way into next year. So now we're weakening job market, and all of this is actually most severe in very specific parts of the country. California, where Angelo is, Florida, where I bought that home too early, Arizona, Nevada, D.C., the industrial Midwest. In fact, if you add up all of the mortgages that back Alt-A and subprime securitized loans, they account for well over 1/2 of all the securities outstanding. So it's California and Florida, and those economies are now in recession. So you throw the economy into the mix, and we're now in a very significant self-reinforcing negative dynamic.
Angela, you say the market needs a jump start. Let's talk about the Treasury plan here to freeze up certain mortgage rates. Will you buy into that? Do you like the plan?
Yeah, I think we gave birth to the plan. To some extent. I mean, we were a contributor to it. We announced about 2 weeks ago a $16 billion initiative on all subprime loans where reset is taking place, that if we determine that they cannot afford the reset, we will keep them at their existing rate for 3 to 5 years until their income catches up. And we've worked with the security holders to work that out. We've done about 55 or 60,000 so far this year. We'll end up the year at about 75,000 of these loans, and we'll continue to do it until we work through the entire book of business or until something else changes. But I agree. I mean, we're in a terrible cycle here, and it's a question of how you get out of it. And my issue is the jump start, and I'll stay on this because it's the only time I'll have the forum. I think Fannie has to play a major role here, Fannie and Freddie. And FHA, and I think FHA is trying to do the best with what they have to work with. I think the only one on this table that continues to take loan applications, and so I reflect because I agree it took a village to get where we are. It's not Moody's alone, it's not lenders alone. It's mortgagors. The reason why I say take loan applications because I asked the borrower what kind of loan they want if they're going to live in the house for 3 years and there's a normal yield curve. They're not going to live 30 years in the house, and they want a lower rate. They select the lower rate, and therefore the 3-year, thinking they'll only be there for 3 years. So I would be opposed to going back to 55 miles an hour since I bought my new car anyway. So America is about choice, and I think that it's very important that we keep as many choices for the consumer, not assume that consumers are stupid. and as many choices as possible for them, as long as the loans are underwritten responsibly. There's no question
Isn't
this
that the
sector.
key, underwritten responsibility?
Yeah, but not taking away, and I agree with that, and absolutely agree with that. But I'm against taking away options for people to buy homes, because I think it does two things. One, I think it hurts the market, but secondly, it doesn't give the consumer what they want or what they need in their particular situation. The problem that we're having now, everything else being stable, if we had liquidity, is that the reason why people go delinquent is for only three reasons. One is loss of health, loss of marriage, loss of job. Those are the only three reasons. People don't wake up in the morning and say, my house is worth less.
Loss of asset, why not?
No. Texas proved that back in the 80s. They do not. If the value of the asset goes down below the mortgage, it doesn't make for great cocktail conversation, no question about it. They don't like that. But they will not leave their home, because it's a home, it's not a house. It's churches,
You're
it's
assuming
schools.
they're owner-occupiers.
They're owner-occupied. I'm not talking about spec. I'm not talking about the investors that got into the
Not a huge
game
amount of
here.
that.
No question it was a huge amount of that. But I'm talking about and of course, that's all gone now as a result of it. No lender can afford to do those loans again. So we're trying to say, what are we going to do going forward? And we do need a viable secondary market. I don't know when that's coming back, because I think that holders of those securities who got screwed are going to say, I'm not going to do this again. Something's going to have to happen to get them confidence to go back and take in mortgage-backed securities. Something will happen. It'll be in a different form, but I think that we got a way to go there. I think the jump start is going to have to be done through government agencies, as it was during the Depression. Fannie was created in '34 when HUD was created for this same purpose. This is a time that they have to step up to the plate and take action and try to create liquidity in the market.
We've already seen some regulation loosened. How much more do you want in terms of Freddie and Fannie, and what about the Fed? Is it, across the table, are we all expecting the Fed to be very aggressive here in the next year?
I guess speaking from my viewpoint, in terms of Fannie and Freddie, I think there's two issues. There's one is having them act, as I think Angelo was talking about. The second is ensuring the strength and stability of the organization. I have to say, from a perspective of an analyst who covers Fannie and Freddie, I've actually been quite pleased with the controls and the strength of the regulator on this issue to make sure that it's responsible in terms of moving forward, especially given the kind of results that we've seen in the most recent releases we've seen for both of them.
Angela?
I think that I come from a different place. I'm not an analyst. I provide finance. Countrywide has been for 40 years about providing people an opportunity for the American dream. So I come from a totally different place, and I think that I don't think there's a conflict between being safe and sound and playing a greater role in this marketplace. I don't think they're mutually exclusive at all, and so I just think it's very, very important at this point of time for Fannie and Freddie to step up to the plate, for the regulator to step up to the plate and make a difference. I think it's the only way out of this thing to shorten this cycle. Otherwise, it's going to be prolonged and very, very painful, and it shouldn't be. People shouldn't be suffering the way they're suffering today.
And the question on the Fed. Everybody thinks the Fed's going to be very aggressive in the next year. What are your thoughts? Let's go down the table. Mark.
Yeah, I think they'll have to be very aggressive. The futures market are anticipating 3.5% funds rate target, and I wouldn't argue with that. I mean, it sounds reasonable to me. So I think the Federal Reserve will have to be, in part because the efficacy of monetary policy has been short-circuited by the housing problems. I mean, the most direct link between monetary policy and the real economy is through housing, at least the most quickest direct route, and that's now short-circuited because of the breakdown of the securities market. So they'll have to press, I think, even more to get a little bit more juice into the economy. But let me just say on policy, I agree with Angela. I think Fannie and Freddie, and I'm surprised we haven't moved on this more quickly. It was a mistake not to 6 months ago. They're the only way to get credit into markets like California. 85% of all loans in the Bay Area of California are non-conforming, and so Fannie plays no role there. So, and Florida, and I think that's vital. Now, their current financial problems are an issue, and I don't know how that plays into allowing them to become a little less fettered, but I think, seriously, think about that. The Treasury Secretary's plan is excellent, except, this is it's easy to say in theory, it's very difficult to implement in practice, because identifying the kind of borrower you want to help is going to be very, very difficult, I think. and to actually have the servicers up and running to implement this is going to be difficult very quickly. So I'm going to advance the ball with two other proposals. One is there's a proposal in Congress to allow for cram downs on first mortgages in Chapter 13. I think that's a great idea. I think that's very important to get passed. If the Treasury plan doesn't work, then this will allow homeowners to use 13 as a way to hold on to their homes. And then finally, I'm not saying that we should do this, but I think we should start thinking about this, is that the federal government may want to think about some RTC-type fund just in case liquidity doesn't come and we've got something in place 3, 6, 9 months down the road. The federal government can step in, like many state governments are doing already, and provide it on a bigger scale and step in and provide liquidity into the marketplace.
Robert, what do you think? First on the Fed, and then comment on Mark's ideas.
The Fed's, I think, obviously behind the curve. The market speaks for itself. I mean, the bond rates are a point underneath where the Fed is, if not more. The Fed didn't plan it this way, but there it is. The market speaks now loud and clear, and they're going to have to get into line. And of course, they're going to want to, too, because we see the economy, notwithstanding the stats that we heard this morning, tanking. And the Fed will do whatever it has to do in order to prevent that tank from taking the ship down. And that is the Fed's job. So I don't think we have any problem there. I think the Fed is going to lower rates. Fannie and Freddie, limits of 417 can help the high-priced regions. So you've got to get those limits raised at Fannie and Freddie. That can be done fairly quickly. And I think Fannie and Freddie are probably the best way out of the liquidity crisis for us. With respect to cram downs, respectfully, I disagree. The key to this business is liquidity in the secondary market. There is no chance that we're going back to a system where the S&Ls give mortgages. We're going to have to live with financing of the mortgage market coming from the secondary finance sector. And if you're going to have the secondary market back mortgages, you're going to have to make those mortgages more sound. You can't wish for the market to reassert itself. You can't wish, respectfully, for the providers to worry about their reputation. You can't wish that S&P and Moody's are going to do a better job, especially in light of the comment that to some extent they had to worry about their impact, which has a tie to it that we don't want to hear. What we're going to have to wish for is that what goes into those secondary bonds, goes into the secondary market, is creditworthy. And you won't get it from an investigation by Moody's and S&P because, frankly, the packages are too difficult. So what you're going to have to count on is that we, with the incentive commission-based system that we're on, everybody's on commission, from the house salesman to the originator, and to some extent, even the home buyer. He walked in and said, I want an 80% 30-year mortgage. And the mortgage originator said, fine, let's do the paperwork. And then he's got his client sitting before him, and he says, you know what, why do an 80-20? I can get you 90-10. You can have lower payments, and so on and so forth, until he's finally got this guy on 100%, and he's busted his credit rating, but he's still at a relatively decent spot, and it helps us because what happens is the salesman says, now we can buy more home for the same amount. And it goes on to the house that flips him into the secondary market, and it goes on to the secondary market. Everybody's working on commission, and they will forever. So I don't see a way of righting the problem until you get into limits as to what you're going to be able to put into these pools before they sell. Otherwise, if you lose the secondary market, you're in a big problem. I think the market, by the way, can turn around quicker and faster than anybody thinks it can. The stats, I believe, are wrong. We're being told by Census, who develops the stats, that 700,000 homes annualized are being built. I called them, said, where do you get your info from? My brothers are down by 50%. I said, what number do you have for cancellations? Are you ready? We don't use cancellations. I said, what do you mean you don't use cancellations? There's 33, 35% cancellations in the market. Well, we believe that stat will right itself when we go to the other side.
That's the new home sales data. The housing,
Right.
the housing starts
No,
data,
I'm talking new.
which is what really matters. That's rock solid. That's, you put a foundation in the ground and they count it.
Right. No, I'm talking
Okay.
about new home sales.
Right.
And they're saying that you've got 700,000 annualized in
Right.
new home sales.
Right.
If they're not deducting the 35%, you're down to 500,000 in new home sales. So the
Market's
inventory.
worse, is what you're saying.
Right.
Yeah.
Well, but also the inventory, because new home sales guides the inventory.
No,
The
it doesn't.
inventory is being shrunk.
No. Well, no,
Well,
not,
we
yeah,
see it.
not the 2.7% homeowner vacancy rate is a completely independent survey done by census. It has nothing to do with the new home sales data report. It's a survey done of the stock.
But the builders are building to sales. They're not building for speculation. And if you don't have the sales, you don't have the building. And if you don't have the building, your inventory will shrink because simply it's not being added to. While the wealth creation didn't go away, immigration didn't go away, job loss is not that terrible. So I think we may see a turnaround faster than anybody imagines.
What's your timing on that? What kind of a turnaround would you expect, in what time frame? When would you expect things to bottom?
I wouldn't expect to see things turn until we start to engage in a debate, a political debate, a presidential debate about how great the country is and what America stands for and how we're going to be moving again. So until the focus comes off of the negative side of the political arena and shifts to the positive side, which you will get once you get candidates starting to pitch to an electorate, as opposed to candidates starting to pitch, now pitching at one another. And unless we get off of the focus as to how bad things are, I don't think you'll see a turnaround. So I think the earliest it'll be is once the presidential debate starts to talk about the future of the country as opposed to the past. It may even take as long as an inauguration and some positive moves. That bully pulpit has got to be used to turn the country around.
You know, if history is any guide, and we can use California as a good guide, or New England as a good guide, markets, housing market corrections, they last a long time. Not that prices and starts and sales have to continue to decline.
That's true.
But they stay at a bottom for a long time, 3-5 years. And I think, given the shift in the psychology in this marketplace, the investor is completely evaporated and is not coming back until we get a new generation that forgot what mistakes we made. This could go on well into the next decade, that we're not going to go back to what we think are normal levels of sales, construction, and price growth until we're well into the next decade.
Yeah, I generally agree with that. If I can make a couple of points. One is Secretary Paulson will be speaking here about Hope Now, and I want to make sure that you understand from my viewpoint that I consider it a very important initiative, and that's why Countrywide is a major part of that initiative. I think we all have to, since we all played a role in creating the problem, we all have to play a role in trying to resolve the problem, and nobody sit back and continue blaming everybody else for it. We all have responsibility for it, and I think what the Secretary has done has been quite courageous in coming forth and trying to get all the lenders together to work on this Hope Now program and working on resets and trying to avoid foreclosures and mitigate delinquencies. So I think it's very important that he continue pushing that initiative, and I guarantee Countrywide will play a major role. And I agree with everything that's been said here in terms of the market turnaround. It took a long time to resolve this problem. It took a long time to get there, and these markets don't come back quickly. And one of the problems that we have is in growing the balance sheet. We talk about the thrifts making these loans. You can't grow your balance sheet because not only has liquidity come out of the mortgage market, liquidity has come out of the market, period. We can't, Countrywide, which operated off of medium-term notes and commercial paper for 40 years, has no access to commercial paper, no access to medium-term notes. There's been a fundamental structural change in the financial services business. And the only way you can make loans is either they're agency loans, FHA, VA, Fannie, Freddie, or you put them on your balance sheet. Well, you can't get access to capital because confidence has not only been lost in the mortgage business, it's been lost in the mortgage sector. And so getting capital put into the banking sector, getting capital to be placed in banks has been very difficult, and you can't grow your balance sheet without capital. So it's a capital and liquidity problem. It is a global issue and very broad in its scope. So we're talking about a narrow, very important part of it, or a narrow part of it, the consumer, and trying to get them, help them out, and trying to stimulate sales. But the whole financial industry has been materially impacted for a long period of time. There's a question, how are you going to get capital liquidity back into the market so we can achieve what we want to achieve, get rid of inventory, and have the average American have access to a mortgage in California, in New England, in high-cost areas. It's a complex issue.
Angela, don't we have to be a bit careful what we ask for in terms of liquidity? If we see liquidity come in at a very low level, isn't that a high risk? I mean, we saw the E-Trade deal last week at 27 cents on the dollar. Some people are trying to apply broadly. I mean, if we see liquidity come back, aren't we in danger of marks that can create all kinds of issues for the financial services sector?
Well, I think you got to take what the market gives you, and I'd rather be breathing than dead. So I just don't know if you can orchestrate it, Fred, that carefully. I mean, I'd love to be able to orchestrate it carefully. We're going to be faced with this Marx issue in any event, because most of the investment bankers have to start marking their book, and so we're going to have not a mark to emit, but a mark to market very shortly, and it is going to be what it is, and it's going to be very, very painful. But I think we just have to go through this painful period to get to the other side. I don't think there's any way to get to the other side without going through some pain.
As far as the fundamental changes, is the originate and sell business model still viable?
Originate and sell in the secondary market? No, it's not a viable model unless it's an agency, unless it's a Joe. I'm not really picking on you, Joe. I like you a lot. It's that, but you are a major factor here. In fact, you're such a major factor. Just take it back. I'm an old guy. I've been around a long time. Been doing something. 14 years old. About 1967, 68. I'm off maybe this year or so. There was total disintermediation in the secondary market, which at that time was savings banks. They had $0, and they reneged on every commitment, and there was no place to sell an FHA or VA loan that year. And every single FHA and VA loan that was originated was purchased by Fannie Mae. Fannie Mae stepped up and said, we will buy every single FHA and VA loan originated in the United States, and they did. They stepped up to the plate and immediately created, within 14 or 15 months, the market came back. Without that, it was over. There's just no way you could originate a loan. What was your question?
I think you answered it. Treasury Secretary Paulson will be up in a few minutes, but let's open it up briefly for some questions. Yes, sir.
Bert Ely, for the record. There has been some intimations in the Treasury proposal, as it's come out so far, that it might go beyond strictly voluntary action within the parameters of existing servicing contracts and securitization contracts, and possibly mandate some pass-through of losses to investors that are outside of the current limits of the contracts that are now in place. If that were to happen, what would be the impact of such an action on the competitiveness of U.S. capital markets and the willingness of foreign investors to buy any type of U.S. mortgage-related investment, if in effect there is an after-the-fact change in contract terms?
What would logic dictate to you would happen?
That's a rhetorical question.
What would logic dictate to you would happen? If you're holding a security that you're supposed to get 100 cents on the dollar because you paid for that, and somebody forces down your throat the fact that you're going to get 70 cents on the dollar, would you buy again?
No. But I'm interested in what, I mean, that's my thought, but I'm interested in what you...
Well, I happen to agree with you.
Thank you, sir. Yes, sir.
Thank you.
Mike Rehard. I cover the home building and building product companies for JP Morgan Equity Research. A couple words that I haven't heard today yet so far is no doc and low doc. And I was wondering if Mr. Mazzillo could address, as he's been in the middle of some of the negotiations right now, aside from reset or loan modification, what talk has there been in terms of applying new standards towards actual loan origination, so that I think as HUD Secretary Jackson said earlier, the integrity of the model can be improved. Thanks.
Angela, we all know that the market went over the top in terms of easy lending. You yourself have spoken about how the industry is at fault partly for this. What is the talk about new standards?
Well, I don't know if there's collective talk. Maybe Jonathan Kempner could talk more about that, what the industry is doing collectively. We're not participating in that, to my knowledge. But I would say, again, I come from the old school, so that whole no-doc and Nina and CISA and all that nonsense that went on, was a concept that was hard to understand, but, the world changes, things improve, there is technology, there are other ways to find out information rather than get the old verification of employment, verification deposit, all the other stuff that we used to get. And so I think there's some middle ground, but a no-doc stated income concept I'm absolutely opposed to. I think that's bad stuff, and that's why you don't hear it anymore, because the lender's just not going to do it. It's just nothing but trouble. There's a reason why someone wants to give you stated income, right? They're lying. Otherwise, they'd give you a piece of paper to tell you what the truth is. So there's major changes have to be made there, if they have not already been made. Within Countrywide, there's been major changes.
So what happened? Just like the dot-com boom, everybody just didn't realize what they were doing? Yeah, you can have a
It's very
home.
hard to see a bubble, Nina. It's very hard to see, Maria, very hard to see a bubble forming. And you've seen, back to the tulip craze, it's very hard to see it, because there's always justifications for it. There's technology. We already know this information. There's FICO scores. FICO score will tell you everything. Why do you need all this information? There's a secondary market that has an insatiable appetite for mortgages. Give us more. There's competition out there that's doing it. The AmeriQuest, the New Centuries, people are not around today, who set the tone, Gresham's Law. Yeah. There's a whole bunch of stuff that went on that when you're not in the middle, because you have to make decisions every day, do I compete? Do I keep my sales force? Because they're going to move to the other company because they have this product and we don't have that product. There's all kinds of things, but I don't think any of us saw, at least I certainly didn't see the bubble growing to this magnitude and busting the way it did.
Let me take a risk and throw our host into the mix, along with the other regulators, because, I think it's in those frenzied lending times when you have, as Angelo nicely put it, Gresham's Law at work, which is clearly the case, the bad driving out the good because of the competitive environment, that's when the regulatory process needs to flex its muscle. And, I don't think we saw that. The first guidance with respect to IO neg-am lending, I think, was last September or October, I believe, about a year ago. The subprime guidance didn't come out until May or June. And, I don't think it's because many in the room didn't know that things were getting frenzied. The problem is that we have so many regulators in the mix, and it's very difficult to get everyone on the same page and in agreement, and then coming to terms on a two-paragraph guidance saying, don't do this, don't originate a borrower assuming that they're going to have a teaser rate forever, because they're not. And so I do think we really need to think about our regulatory framework. The regulatory process we have in place was invented in the Great Depression, and it feels like it. It really does. I mean, I really think we need, because going forward, we're not going to have a problem in the mortgage market for long in the future, but we are going to have other problems in other lending markets, and we need a better regulatory process. Someone to play bad cop and say, this doesn't make sense. State income loans for a self-employed worker, okay, that makes sense. But if you are on a payroll and you have a W-2, how do you explain that? How do you explain it? The regulator should have said, or someone should have said to everyone involved, this doesn't make sense.
I think, I never say these words, in defense of the regulators, when they came out with the joint agency guidelines, Mark, there was a lot of resistance. When they came out with with not extending the teaser rates and all the other types of loans we were making, that there was deep concern and resistance from the lenders about what the hell you know what you're talking about. It was because everything was going so well, and so I think that they tried. First, it was hard for them to see as well. It was very, very difficult for them to see in a raging market when Bob's coming and putting up tents and holding lotteries in order to control the crowds in their subdivisions.
Those were the days.
Yeah. So who was to say that the system wasn't working? And I think that the joint agency, the FDIC, the OTS, the Fed, the OCC, when they came out with their collective guidelines about a year or so ago, I think that was quite courageous in light of everybody saying, what the hell are you talking about, things that are doing well. So it was a hard thing to call. We're human beings, we're vulnerable, and we're not perfect.
Maria, what happened was we could, and so we did. The appreciation of the asset was the amortization on a 100% no-doc, interest-only loan. So you didn't have to worry. The buying of the bonds, you didn't have to go into the tranches. You really didn't care because it was all backed by an asset that was going up by 15, 20% a year. So you couldn't lose.
Final question, do you see cracks to the global economic story, and are you expecting the economy to worsen substantially, given that housing is so much more important to the broader economy today than it was 10 years ago?
Yes.
Yeah, I think I would agree. I think one of the issues that's so critical right now, and the issue of liquidity and the question that was posed and answered in the back, is this issue of contract law. We have to make sure that we don't impinge on that issue globally, so that these securities, when they do find a market, even at low levels, Angelo, people do know what they're buying.
Well,
I'm sorry. Oh, I'm sorry.
final comment, Mark.
Well, my view is I think the economy is contracting. I think if we have a few more months of what we got in October and November, it'll be deemed a recession. We're right there.
Gentlemen, thank you. Thanks, everybody. We want to keep it to time. Hank Paulson's up next.
Please take your seats as quickly as possible. Please take your seats. We have the Treasury Secretary Paulson on his way in. Everyone, please take your seats.
It's my great honor and privilege to introduce the 74th Secretary of the Treasury of the United States, Henry M. Paulson, Jr. Secretary Paulson was nominated by President George Bush on June the 19th and unanimously confirmed by the United States Senate 9 days later on June the 28th of last year. Secretary Paulson is the President's leading policy advisor, on a broad range of domestic and international economic issues, including capital and the mortgage market issues. Prior to coming to the Treasury, he had a 32-year career with Goldman Sachs and was chairman and CEO from 1999 through 2006. Prior to joining Goldman Sachs, Secretary Paulson was a member of the White House Domestic Council, serving as a staff assistant to the President in 1972, 1973, and as a staff assistant to the Assistant Secretary of Defense at the Pentagon from 1970 to 1972. Graduate of Dartmouth, member of Phi Beta Kappa and All Ivy, All East, honorable mention All-American for football, received an MBA from Harvard. He and his wife, Wendy, have 2 children. Please join me in welcoming our Secretary of the Treasury, Hank Paulson.
Thank you very much, John. The Office of Thrift Supervision plays an important role in our financial system, and I very much appreciate your leadership at this agency. Thanks also for hosting the 2nd Annual National Housing Forum and providing a timely opportunity for me to give an update on the U.S. economy and mortgage markets. I mention timeliness because housing issues are affecting citizens all across the country and because Congress returns to Washington today. In the final days of the congressional session, there is much that Congress can do to help American homeowners. As we are all aware, the housing and mortgage markets are working through a period of turmoil, as are other credit markets, as risk is being reassessed and repriced. We expect that this turbulence will take some time to work through, and we expect some penalty on our short-term economic growth. The positive news is that we are confronting and managing these challenges against the backdrop of a strong global economy, and the U.S. economy remains fundamentally sound. Core inflation is contained, continued job gains are providing a good foundation for household spending, corporate balance sheets remain healthy overall, and strong growth abroad is supporting U.S. exports. Our economy will continue to grow, but it is facing a number of challenges. And, as I've said before, the housing market downturn is the biggest challenge to our economy. When home foreclosures spike, the damage is not limited only to those who lose their homes. Homes in foreclosure can pose costs for whole neighborhoods as crime goes up and property values decline. Avoiding preventable foreclosures, then, is in the interest of all homeowners. Mortgage market financial innovation has benefited the U.S. economy and U.S. homeowners. It has also introduced some of the challenges we are facing today. Financial innovation led to the creation of mortgage products that put homeownership within the reach of more people. At the same time, innovation also made riskier loans with no down payments or minimal documentation and made these loans more widely available. Similarly, securitization has brought benefits and challenges, making more capital available to mortgages, but creating greater market complexity. As a result, we now have an array of different market participants, often with different interests. Still, foreclosure is expensive for all participants, lenders and investors, and this expense is a very important incentive to avoid foreclosure when a homeowner has a financial wherewithal to own a home. An appropriate role for government is to bring the private sector together when innovation has greatly increased the complexity of achieving beneficial solutions for all parties involved. The number of subprime mortgage resets is going to increase dramatically next year, and we need to make sure the capacity is there to handle it. And so Treasury is aggressively pursuing a comprehensive plan to help as many able homeowners as possible keep their homes. We began by convening a diverse group of market participants who represent all segments of the mortgage industry. Based on what we've learned, we are implementing a 3-point plan to avoid preventable foreclosures and to minimize the impact of the housing downturn on the U.S. economy. First, we are increasing efforts to reach able homeowners who are struggling with their mortgages. Second, we are working to increase the availability of affordable mortgage solutions for these borrowers. Third, we are leading the industry to develop a systematic means of efficiently moving able homeowners into sustainable mortgages. This morning, I'll provide more detail on the three elements of this plan, an update of the private sector's efforts, the government's efforts, and the additional steps that are needed in each area. First, we must reach homeowners who are struggling, reach them early, and reach them with information and with hope. The need for this effort became starkly clear when we learned that 50% of foreclosures occur without borrowers ever talking to their lender or a mortgage counselor. We know that if we're able to make a difference, that number has to be reduced. We learned that mortgage industry leaders had already stepped up their efforts to reach delinquent borrowers, but many borrowers in trouble were afraid to speak to their lenders. Borrowers did respond more favorably to mortgage counselors, but the counselors didn't know which borrowers needed the assistance. Treasury and HUD helped bring these two groups together in the Hope Now Alliance, a coalition of mortgage servicers, counselors, and investors who are working to avoid preventable foreclosures and to improve the functioning of the mortgage market. Since its formation less than 2 months ago, the Hope Now Alliance has made significant progress. In the past, some servicers may not have contacted borrowers until after their loans were delinquent. Today, all Hope Now servicers are contacting borrowers 120 days in advance of their mortgage reset to reach them early before their mortgage problems become overwhelming. For those troubled borrowers that servicers haven't been able to reach, Hope Now has launched a nationwide letter campaign. These simple one-page letters on Hope Now letterhead provide a toll-free hotline which homeowners can call to explore options with their servicers that may help them keep their home. Mortgage investors recognize that foreclosure is costly and often not in their interest, and they recognize that quality mortgage counseling can help prevent foreclosures. By bringing together counselors, servicers, and investors, the Hope Now Alliance has brought the resource of investors to bear to enable nonprofit mortgage counselors to be more widely available. The Alliance is scaling up a national hotline that borrowers can call for mortgage counseling. And let me say to those listening out there, if you are worried about losing your home, call this number, 1-888-995-HOPE, to see if you are eligible for assistance. Now, I hope none of you are going to need to call this number, but please feel free to do so if you're going to have a problem. Now, this hotline is available 24 hours a day to provide vital mortgage counseling in multiple languages. Nothing is worse than doing nothing. The Hope Now effort to streamline refinancings and modifications is a positive step, but it is not a silver bullet. There is no single solution to address all of the issues currently affecting the housing and mortgage markets. The government has a role to play as well. First, we need to draw attention to these letters and urge borrowers who receive them to act on them. Secretary Jackson and I have been doing just that, and we have recently sent copies of these letters to all members of Congress so that they can alert their constituents. We are asking mayors and governors to do the same. We will also join Hope Now's efforts to broaden its public service announcement campaign to spread the word that hope is but a phone call away. While increased industry funding is very important, we also need to do our part to support nonprofit mortgage counseling organizations. For this public outreach campaign to be successful, there must be enough trained mortgage counselors to answer the phone when homeowners call. The administration's request for funding NeighborWorks America and other nonprofit mortgage counseling operations is in its budget, but the appropriations bill has yet to be finalized. Congress needs to get it done and get it done quickly. Of course, reaching homeowners is only part of the equation. The second part of our action plan is to make more products available for borrowers who have the financial wherewithal to own a home but are struggling with a higher adjusted rate on their subprime mortgages. To help with this, the industry is looking at several innovative solutions, including both modifications and refinancings. State and local governments, especially in the hardest hit areas, are also developing solutions, including proposing funds that may help financially able borrowers refinance out of expensive subprime loans. Given the local nature of the housing markets, state and local solutions can be particularly effective. Current laws allow states and localities to issue tax-exempt bonds only to assist first-time home buyers or home buyers in designated distressed areas. Some states' housing agencies have initiated pilot programs backed by taxable bonds to help refinance struggling subprime borrowers into more affordable mortgages. Today, we are proposing to allow state and local governments to temporarily broaden their tax-exempt bond programs to include mortgage refinancings. If enacted, this will reduce the cost of innovative mortgage programs and allow these programs to reach more struggling homeowners. We in the federal government are also taking steps. This fall, HUD initiated FHA Secure to give the FHA more flexibility to help more families stay in their homes, even those who have good credit but may not have made all of their mortgage payments on time. An estimated 240,000 families can avoid foreclosure by refinancing their mortgages under the FHA Secure Plan. The administration is taking action to help homeowners, and Congress must do the same before it leaves this year. Since August, the President has been calling on Congress to pass his FHA modernization proposal, which, by lowering the down payment requirement, increasing the loan limit, and allowing risk-based pricing, will make affordable FHA loans more widely available. The administration's proposed bill would help refinance another estimated 200,000 families into FHA-insured loans. Since August, the President has also called on Congress to provide tax relief for mortgage debt forgiven. Homeowners who finally find relief shouldn't get put back in financial straits because of the tax code. Additionally, Congress needs to complete its work and create a strong, independent regulator for Fannie Mae and Freddie Mac. Fannie Mae and Freddie Mac have an important role to play in making mortgages available and affordable. An appropriate regulatory oversight is critical to their ability to serve their public policy purpose. The third element of our plan involves a pragmatic response to the reality that the number of homeowners struggling with their resetting subprime mortgage will increase throughout 2008. As volume increases, we will need an aggressive, systematic approach to fast-track able borrowers into a refinance or mortgage modification. This third element does not and will not include spending taxpayer money on funding or subsidies for industry participants or homeowners. While the reality is a bit more complex, in the interest of simplicity, there are four categories of subprime borrowers. First, there are those who can afford their adjusted interest rate. These homeowners need no assistance. There are also a substantial number of homeowners who haven't been making payments at the starter rate on their subprime loan and may not have the wherewithal to sustain home ownership. These homeowners will likely become renters again. A third category of homeowners might choose to refinance their mortgage, putting them in a sustainable mortgage while keeping investors whole. This is the first best option. Servicers should move quickly to assist those who can refinance. And the fourth category is those with steady incomes and relatively clean payment histories who could afford the lower introductory mortgage rate but cannot afford the higher adjusted rate. We are focusing on this group, determining who they are and what steps may be appropriately taken to assist them. However, given the diffuse nature of today's mortgage market, the steps toward refinancing and modification can be more difficult than it would seem. The company collecting your mortgage payment every month is most often doing that on behalf of those who own the mortgage, and they are limited in the decisions that they can make on behalf of those ultimate owners who are spread all over the world. We are determined to bring this diverse group together, to develop a set of standards that will be implemented across the industry, from the largest mortgage servicers to smaller specialty servicers. An industry-wide approach is critical to the effectiveness of this effort. To speed up the modification process, we are working through the Hope Now Alliance with the American Securitization Forum to convene servicers and investors so that they can develop categories of borrowers eligible for appropriate modifications and refinancings and an industry-wide solution. This work takes time, as all parties seek to define categories of borrowers for streamlined refinance and modification where that is in the best interest of both the borrower and the mortgage investor. I am confident that we will finalize these standards soon, and I expect all servicers will implement them quickly and create benchmarks to measure their progress along the way. As a result, what has been a fragmented, cumbersome process can be a coordinated effort which more quickly helps able homeowners. Through continued dedicated efforts by industry, nonprofit organizations, and the government, we can strike the necessary balance to mitigate the risk to our economy of this housing downturn. The issues are complex and will take time. We are working aggressively and quickly, utilizing the available tools and creating new ones to help financially responsible but struggling homeowners. This, in turn, helps our neighbors by preventing foreclosures and sales, which can drive down property values and undermine the financial stability of families and communities. It also helps investors and lenders avoid unnecessary and costly foreclosures that are not in their interest. We will continue these efforts, measuring progress and making adjustments when necessary to ensure that as many able homeowners as possible are reached and helped. The administration and the private sector are taking action. Congress needs to act now to appropriate funds for mortgage counseling, to pass FHA modernization and GSE oversight legislation, to pass legislation to temporarily relieve liability for mortgage debt forgiven, and legislation to temporarily increase capacity and allow state and local governments new flexibility to use tax-exempt bonds for home mortgage refinancings. The U.S. economy and America's communities deserve no less. Thank you very much.
Thank you, Mr. Secretary. We're going to take a 15-minute break now. We'll be back here in 15 minutes.
Break, girl.